Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is late in the day of Thursday, June 5th, so we have some somewhat breaking news on a growing feud between President Trump and Elon Musk, and that is already causing some ramifications in markets. So, whereas I have a title in this podcast about trading barbs, this actually did not include trading those barbs, but we can see that we have a lot of interesting news flow to dissect this week. And let's get straight in, and I will share the slides. So I've called this podcast The Hand That Feeds You. And what that is in reference to is the concept of biting the hand that feeds you. And what I asked is whether we are essentially in the US biting the hand that feeds us in terms of some of the actions around foreign students, and equally around assuming that we will have non-US investors investing in the US regardless of the restraints that we put in place, and certainly regarding taxes, as well as any penalties such as tariffs that affect the home country. We could also apply this phrase to the growing feud between the president and Elon Musk, in that each of those parties may well be considered to be biting the hand that feeds it, in that the president may consider that the support from Elon Musk was pivotal in the election, and now he has essentially perhaps cut off subsidies to Tesla and maybe gone back on some of the promises that were made there. Whereas equally, the president might suggest that the work and the leeway he gave Elon Musk in Doge, and now Elon's turning on him, is essentially the same as the hand biting the hand that feeds him. So lots of ways of interpreting that title this week. As usual, we discuss the five fingers of the hand: inflation, interest rates, geopolitics, equity markets, and other. And we have some discussion of some of the other asset classes that this would affect. This has been a somewhat sluggish week in markets, not much to report. Ongoing, on again, off again tariff negotiations and a dialing up of the temperature between President Trump and President Xi, and then a recent 90-minute phone call, which seemed to cool temperatures there somewhat. All of this is feeding in to the sentiment in markets real time. We've seen barbs flying with respect to trading partners, as well as around the big, beautiful bill. So a little bit of a hostile environment still in Washington, and certainly many suggesting that this big, beautiful bill is trying to pack too much in. And essentially, there are some factors that are not even been focused on, particularly around non-US investors, which we will discuss later. A fascinating thesis has been circulating this week around American exceptionalism, supporting the growing notion that this exceptionalism is being chipped away at. And then if America is no longer exceptional, does that give a chance to other countries and markets to be looked at on a level playing field, suggesting that if no one is exceptional, everyone can be. And that is, in fact, a growing thesis, that some of the woes in the US are looking very good, in fact, for non-US countries, and will bode well. And similarly, capital flight out of the US, due to some of these surprise factors that have risen, will in fact lead to capital flows into other countries, not necessarily based on merit, but because their next best option has essentially been taken away. We look at dollar demise, ask how much of that is intentional and whether that is a problem. And then getting back to the concept of biting the hand that feeds us, we'll look at some headlines there. In terms of inflation, what are we seeing? It's important to look now across the world at inflation pictures. Not much news on the US inflation front this particular week, but we have seen that European inflation gaps, the gap is still in place with the US. This chart on the left shows the difference between the German 10-year break-even and the US 10-year break-even. And we can see that while European inflation spiked during the energy crisis regarding the Ukraine, that ever since there has been a steady decline and dispersion with the US inflation expectations on the part of Europe. So clearly there is a different picture in Europe with regards to inflation, and the ECB knows that. We've spoken about how in the US service inflation was still the real core, getting to the what is driving mainstream inflation, and that was coming down. Service inflation was coming down, which was encouraging. The same factor is happening in Europe. It never spiked by as much as US service inflation, but European service inflation, Eurozone, has been steadily coming down, getting quite close to its 2% target at this stage. When it comes to economic activity, we have a mix of indicators this week. Last week, we showed the surprise spike in consumer sentiment and how that sat at odds with the growing concern among CEOs, where 83% of CEOs had suggested that there was going to be a recession in the next 12 to 18 months. That surprise jump in consumer sentiment seems to be a little bit of an outlier, as if we look at the US Beige Book Activity Index produced by the Federal Reserve as an indicator of economic sentiment and activity, we can see that that is trending down again. It did dip a lot during the crisis in the past, especially COVID, but we can see that it is now, having hovered in a range, it is now at the bottom end of that range. So clearly this uncertainty that we've discussed before, some of the distortion in terms of bringing forward the supply and imports and demand in the first quarter, that has now been trickling in to the second quarter with a lot less of that kind of activity. And then this beige book also does a count of word count in the earnings, and what is popping up more and more again, the red line being an indicator of what was coming up in May 25. And we can see that the mention of slowdown, recession, supply and supply chain constraints are pretty much close to highs, not at a high. Inflation similarly, but the mention of uncertainty and tariffs are it's round about higher in the case of tariffs than they were last month, slightly lower in the case of uncertainty. I suppose the longer you have uncertainty, the less you have to keep mentioning it. So that's probably a reason for that. But clearly tariffs on everyone's mind, and that is continuing to be the main factor that drives markets. Then if we look to why this activity then will translate into different rate path, we've just had yesterday the 8th ECB rate cut in 8 meetings. That was well telegraphed and expected, but definitely a reaction to this fact that we've seen Eurozone headline inflation steadily trickle down and even dip below 2%, but certainly around the 2% target. And then the ECB rate now also at 2%, as that latest cut brought it to that level. So quite a stimulative monetary environment in Europe. And interestingly, not necessarily correlating with weakness in the euro. Typically with a lower yield, we would see a loss in demand for a lower yielding currency like that. But due to the fact that there have been such woes on the side of the US dollar, that there is a look for other reserve currencies, the euro is fairly deep, fairly liquid, and that could be potentially a source for other investors seeking a safe haven. So not as much weakness as we might expect with that interest rate fall. However, we now see a little bit of that same action on the US. We've seen some bond yields fall. Some of this weak data is now spurring hopes for a rate cut. And we're again seeing hope start to kind of coalesce around 1 or 2 rate cuts this year. So the Fed by no means committed to doing no rate cuts, definitely data dependent. And the recent rate cut by the ECB has now heightened some pressure, some political pressure on the Fed to cut rates in that way. When it comes to the Treasury yield, I mentioned that it had been coming down. It has ticked up, so however slightly since its low, and that is a reaction. It's still well below 4.5%. This is just the last few days of movement in the Treasury yield. It's still down, probably because of that tick upwards in equity markets, a sense that the tariffs, that the bark was worse than the bite. But we are still seeing a reasonable amount of turbulence in the Treasury yield. And I just spoke on Bloomberg Asia about this today, how the DM bond fixed income volatility is starting to look so high that in fact is resembling emerging market fixed income volatility. And that is really just changing the playing field when it comes to buying bonds. If we have the case where developed market fixed income behaving the same as emerging market fixed income, we would ask ourselves if we are being paid, in the case of developed markets, for that risk. So certainly it has been a little bit of a more volatile period for fixed income recently, and that has taken its toll for people who hold bond funds, as holding a bond to maturity is one thing, but holding it in a fund that is forced to crystallize a loss amid this volatility can lead to some losses which are perhaps not expected in the realm of fixed income. Where else are we seeing uncertainty? Well, certainly when it comes to commodities markets, some of the geopolitical stresses have caused a bit of this uncertainty. We've also seen some interesting movements in oil. We'll show later how oil seems to be more resilient to geopolitical headlines, but there have been movements downwards essentially in oil, and that this turbulence in commodities markets continues to create uncertainty there. And then when it comes to the uncertainty around manufacturing, we have a chart showing that for the first time since 2023, US manufacturers are gloomier than Europe's. Some of this may be a factor of the uncertainty around trade that we mentioned. There was a canvassing of opinions from leadership across a wide range of US companies, and even the homegrown industrial companies have expressed a lot of concern around the impact of trade wars on their business model. So essentially, even the businesses that were supposed to be protected by trade protectionism are feeling that this uncertainty is challenging, particularly as their supply chains have become more globally integrated. So that probably is a reason for some of the gloom. Europe, obviously, there will only be a portion of exports sent to the US, so that will not dominate their economic picture, and that perhaps the gloom maybe is out of the system in Europe, having been definitely the backdrop for many years. When we look at how markets, though, have been adapting to some of this uncertainty, I mentioned before the oil price and how that has been actually relatively calm. The interesting point is that we've seen, if we look at just there's a number of charts on this page. First of all, we look at the oil price and how low it is. Part of the reason it seems to be so low is this ongoing concern around economic activity. But there has been a lot less volatility in oil than we would have expected, particularly given some of the flashpoints of geopolitics that could affect the demand for oil. And Treasury, equally, I mentioned it has been more volatile, but just in the last few days, we have seen it tick downwards in terms of the Treasury yield. When it comes to an optimism indicator, the composite optimism indicator, which is shown here from looking at business cycle, corporate earnings, equities, bonds, etc., is still positive in the US despite all of the downturn that we've seen in consumer sentiment. It has been lower, it has been trending lower, but overall it still seems positive. And that would square firmly with some of this equity market sentiment that we're seeing. There has been, as I said, a rally in the aftermath of a sense that trade was not likely to be as acute and as severe as expected. That has led to some kind of optimism. Another interesting chart around equity market volatility, which suggests that certainly in Europe, it remains far below its peak after the Ukraine and the invasion of Ukraine. So whereas it spiked at that stage, it has not got even close back to that level again. Some small spike during Liberation Day, but otherwise back to a very low baseline. So why is that? And this is a suggestion that some of the Ukraine turmoil has really just receded into the background as background noise and is not driving investment decisions and is not driving market movements. And that does seem to be the case. That generally happens with time. But it's also the case that there haven't been dramatic developments there, with the exception of this week when we saw successful drone attacks within Russian territory by Ukraine, and so far no retaliation, but a suggestion that there will be severe retaliation. So that could well lead to something more significant in terms of news flow there. But equally, if we look even at the US VIX, the volatility index there, quite a spike, dramatic spike during Liberation Day, the highest spike we've seen in about 18 months. However, after that, it has really receded. And again, some of this could be due to the buy and hold behavior that many US clients are starting to adopt. We've also, the movements were so sharp, perhaps there wasn't time to react. But for the most part, we're still looking at an overall backdrop of low equity market volatility. When it comes to sentiment, then I mentioned already that it has been slipping. Some more slides here for those watching online that will just show how latest round of data has been disappointing. Optimism for the US sector has been slipping more in some of the US than in Europe. Europe has actually been somewhat low. So all of this shift in sentiment, all contributing to that siren call for a stimulative rate cut on the part of the Fed. This interesting chart I mentioned already, that oil seems to be more resilient now. And I'd say that when it comes to geopolitics, we can see that oil, perhaps due to the increased supply of oil from the US, the domestic supply has led to it be less reliant on imports. I think other energy sources, the diversification beyond fossil fuel, has been also very meaningful in this. And suffice to say that oil is no longer the bellwether of economic strength and economic health in the world that it used to be. There's a chart here showing just how the oil price has spiked over various developments in the world. And I'd say the latest uptick in the Ukraine war has led to a very, very modest spike in the oil price, but nothing close to what was even during the initial invasion and during other turbulence in the Middle East. So oil is getting just generally less less reactive, more resilient around geopolitics. And that, I think, is also what goes for oil, goes for markets. Looking again at the other markets and how they are faring relative to the US, we have heard a lot about flows out of the US, particularly this week. We're seeing headlines around big investors shift away from US markets. This is some of the workaround that we talked about before, as we have a workaround such as Canada and Mexico looking for alternate trading partners. There is a suggestion that the US, because of the uncertainty, simply would you invest your marginal next dollar, pound, euro in the US, or would you put it somewhere where there's more regulatory and certainly legal certainty? That is a question. When we look at some of the knock-on effects of this US kind of a slow drip feed of a slow drip of investments out of the US, we can see that the S&P's performance relative to the FTSE All World, excluding the US, it remains under in terms of it remains under its 200-day moving average. So relative performance, and even if we look at year-to-date numbers, relative performance of US markets has not been strong. And interesting, another collateral perhaps effect of the weaker dollar has been that there has been a rebound in emerging market currencies, and that they have enjoyed the fact that the trade gambit has not always been as severe as expected. So a positive outcome for emerging market currencies, which could indicate more confidence in emerging markets, again, based on this thesis that if the US is no longer exceptional, if no country is exceptional, that the emerging markets themselves have a chance to show their fundamentals. If we are to look at another evidence of the valuation gap, the transatlantic valuation gap, and whether that is most extreme when we include the Mag 7 or just look at the other 493, we can see that the valuation gap since ChatGPT has really broken away for the S&P 500, which of course includes the Mag 7, and that really has not subsided. It has continued to be an outlier relative to the other 493, that this still has led to US stocks becoming more expensive. So when we talk about the flight out of US assets, it could still be the case that the US assets are seeing outflows not simply based on macro factors and on political factors, but also based on pure valuation factors. Getting to the idea of biting the hand that feeds us, headlines this week about Trump halting new foreign student enrollment at Harvard. We've also seen this attacks on other Ivy League institutions, suggesting that Columbia could have its accreditation removed. These are all somewhat sinister, I'd say, chipping away at the educational institutions. We've known that their funding, federal funding, has been pulled, but this also will start to have an effect on foreign families wanting to send their students to the US to study. This is likely to have an effect on researchers, PhD students, also even on faculty itself. A number of faculty members are perhaps not from the US, and who knows if their visa status is secure. So I think this is another development that is likely not to be evident in numbers initially, but could certainly cause some outflow of talent and research and innovation in the future, as well as a lack of desire for students to flow in there. That's a big source of education dollars, certainly, is foreign students. Yes, there will be more space for domestic students, but this could have a very long-term effect on the desirability of US education. Looking again at biting the hand that feeds us when it comes to the investment of non-US investors in the US, we know that for some time, the fact that there was this trade deficit in place usually led to those dollars being rediverted into the US to buy US treasuries or buy other US assets. And that was the reality, that if the president sought to unwind some of these trade deficits and even turn them to surplus, that there would be less dollars in foreign hands that would seek a home in US assets. It's interesting to just look at the extent of the net US investment position, i.e., there is clearly more money invested by non-US investors in the US than there is by US investors outside the US. This is framed in this chart on the top left as a large deficit when it comes to the international investment position. So this large deficit essentially leaves scope for repatriation of those funds. There is particularly if there is, as is suggested in the Big Beautiful Bill, Section 899, a provision that would increase tax rates for certain non-US persons and governments. This is perceived as relating to some countries only, any country that has a punitive or unfair tax regime in place vis-a-vis the US, but this would include most of Europe and even countries such as the UK, which would have some form of alliance with the US, that could even also be deemed to be an unfair tax regime. So if there's potential for additional taxes, as of now uncertain, because these will be incremental withholding taxes that would start to rise every year, this would be another reason to take capital out of the US before these taxes go into effect. So as we can see, there is a lot of money that could potentially flow out. And that again could be another evidence of the US government biting the hand that feeds us. I don't think there should be an underestimation of the goodwill of non-US investors to stay invested in the US if they find the lion's share of their returns and profit essentially are being taxed. And we should bear in mind that these profits have not been that compelling in recent years with inflation, with the general reduction of returns. Outsized returns have not been the norm. So if we start to tax mainstream returns in terms of their range, that's going to really make the difference between investing on the home front for these investors or investing in the US. Here, many investors are already voting with their feet. We have a quote from Lou Lukens of Signum Global Advisors, who said, "The president's viewpoint is that there is such immense foreign appetite to invest in the US that it is not at risk of being thrown off course." That is exactly the presumption that may be incorrect and may lead to the US biting the hand that feeds us. We also have other evidence versus if we look at the dollar, how the move out of the US continues, even with risk assets surging. So that is another interesting direction of travel that we don't normally see. We're already seeing the dollar index close to the lows that were last touched at the end of last year. So a reversal of most of that. And then if we look again at the relative performance of the US stock market versus other stock markets at this juncture have been looking more attractive. And finally, it's worth a note on clean energy and where we stand with that. We know that in the Big Beautiful Bill, there are suggestion of rollback of stimulus for consumers around solar panel installation, as well as EVs. And a few weeks ago, we looked at the impact that that had on solar stocks. We have had a little bit of news on BlackRock. We see that they are back on the Texas buy list again after their climate policy rollback. And that says the decision allows the state funds to buy shares in the asset manager and invest in its funds following a 3-year boycott. During those 3 years, BlackRock did take measures to reduce some of its rhetoric around sustainability. It left certain voluntary alliances, such as the Net Zero Asset Owners Alliance, and it's leaving those alliances essentially led to many of those alliances disbanding. And we know that it has reined in some of its engagement behavior, its activism, as well as even its launch of some funds. So this did cause some woes for BlackRock in countries such as the Netherlands, where we know that they had the opposite point of view around sustainability action. But clearly within Texas, there has been enough action now to allow them back on the list. There has been suggestion this would lead to a different type of dialogue when it comes to oil and gas. Obviously, this has become a political issue, and we will see how that develops. But it's interesting that there's already been a rollback of that policy. And we can see that clean energy, as measured by the Clean Energy Index, has generally had quite a woeful time. We haven't seen it burst out from the old world energy index since the aftermath of COVID and 2021. Now it is trading back at a level that completely is actually under the MSCI All World Energy Index. And that is a sign that some of the sheen has come off clean energy. But I think this is a short-term thinking. If we look at the long term, we know that with data centers, with the increased demand for energy that AI and its surging demand is likely to cause, I don't think we should be writing off just yet the demand for clean energy. A lot of very interesting technology and funds being developed. And we know also, thanks to Ian Bremmer, that in Texas, it's one of the solar energy is growing at a tremendous pace. So that is it for this week. As I said, not much move in markets, a little bit of focus now on the growing feud between the president and Elon Musk, less focus on fundamentals right at this time. We're poised to see some Fed action at their next meeting, given what's been going on around the world. And we have a slightly weaker set of demands around economic indicators, and that could also suggest that markets are not losing some of their verve that we showed in the beginning of the year. Lots to watch. Thank you for looking, and thank you for joining. We'll see you next week.